Stage 1, the starter debt. You do everything right. You go to college because everyone told you. That's the path. You take out $38,000 in student loans because that's the average now, and nobody hands you a warning label with the paperwork. You graduate. The job you get pays $42,000 a year, which sounds like a lot until you split it across rent, a car payment, food, and a loan that starts collecting interest the moment you stop being a full-time student. The minimum payment on your student loan is $310 a month. That number was calculated by a formula, not by anyone who looked at your actual budget. It doesn't know your rent went up $200 this year. It doesn't know your car needs new brakes. It just knows the schedule, and the schedule doesn't move. You are not behind yet. You are current. But current now means something different than it used to. Being current means you are making the minimum payment every month while the principal barely shrinks because most of what you're paying is interest. You are running on a treadmill that was built to look like a staircase. This is the entry point, not a crisis, not a headline, just a 23-year-old with a degree, a job, and a debt that will follow them for the next 15 to 20 years quietly in the background before almost anything else happens in their financial life. Stage 2, the convenience trap. You need a couch, or a laptop for the job you just got, or new tires, and there, right at checkout, is a button. 4 payments of $49.99, 0 interest, approve in seconds. You click it because it feels like nothing. It feels smaller than debt. It doesn't feel like a loan, because nobody calls it a loan. By now, pay later services processed over $75 billion in transactions. In a recent year in the US alone, most of that volume came from people making under $50,000 a year, the exact income bracket that has the least room to absorb a missed payment. The pitch is convenience. The mechanism is debt, just repackaged so it doesn't trigger the part of your brain that says, wait. Here's what makes this stage different from a credit card. There's no single dashboard. You don't see all 4 of your BNPL loans in one place. You have one through Klarna for the couch, one through Afterpay for the laptop, one through Affirm for the tires. Each one looks small on its own. Together, they're a second rent payment you never agreed to. In a single sitting, you agreed to it 4 separate times, 30 seconds apart, each time convinced it was nothing. Miss one payment and most of these services charge a late fee, and some report to credit bureaus now. The 0 interest promise was only ever the entry price. The trap isn't the interest rate. The trap is that you can't see the whole debt at once, so you can't feel how big it's actually gotten. Stage 3, the card that rescues you. Something breaks. It always does. A $600 car repair, a $900 emergency room copay, a security deposit for a new apartment. You don't have $600 sitting free in checking because nothing in stage 1 or stage 2 left room for that. So you put it on a credit card. The average credit card interest rate in the US right now sits above 24%. Not because you're a bad borrower, because the entire system prices doesn't have savings as risk, and risk gets charged for. You tell yourself you'll pay it off next month. Some months you do part of. Most months something else comes up first and the balance doesn't go to 0, it just goes down a little and then back up. This is the part nobody explains clearly. Minimum payments on credit cards are structured so that most of your payment covers interest, not principal. A $5,000 balance at 24% interest paid at the minimum can take over 15 years to clear and cost you more than double the original amount in interest alone. The card that rescued you in the emergency becomes the thing quietly draining you every month after. You are not irresponsible. You are doing exactly what the product was built for you to do. Stage 4, the medical bill that changes nothing and everything. You get sick, or your kid does, or you need a procedure that isn't optional. You have insurance, most people in this trap do, and you still end up with a bill for $3,200 after the insurance covers its share. Deductibles, copays, out-of-network surprises. The bill arrives often months later in an envelope that looks like every other piece of junk mail until you open it. Over 100 million Americans currently carry some form of medical debt. It is now one of the leading causes of bankruptcy filings in the country, not because people are reckless with money, but because a single unplanned health event can cost more than most households have in savings, and most households at this point in the trap have almost none because stage 1 through 3 already absorbed it. Hospitals will often let you set up a payment plan. That sounds humane, until you realize it functions the same way as every other debt in this list, a recurring monthly obligation stacked on top of the ones you already have, extending the timeline of when you might actually feel like you have breathing room. Stage 5, the car you need to get to the job that pays the debt. You need a car to get to work. There's no meaningful public transit option where you live. Most of the country doesn't have one. So you finance a car because paying $35,000 cash isn't a real option for someone carrying the debt from the first 4 stages. The average new car loan in the US now runs close to 7 years. 7 years of payments on an asset that loses roughly 20% of its value the moment you drive it off the lot and continues depreciating. Every year after that, you are paying down a loan on something worth less than the loan. For most of the loan's life, this is called being underwater, and a significant share of people trading in a car right now are doing exactly that, rolling the remaining balance of the old loan into the new one so the debt doesn't disappear, it just changes shape and starts over. The car isn't the trap. The car is required. That's what makes this stage different from the others. It's debt you can't opt out of if you want to keep the job that's supposed to be paying off everything else. Stage 6, the house that was supposed to be the win. Eventually, if things go well enough, you buy a house. This is supposed to be the stage where the story turns, where debt becomes an asset instead of a hole. And for a long time in this country, it worked that way. It works differently now. Mortgage rates that were under 3% a few years ago are now closer to 7%. The median home price has climbed faster than median income for over a decade straight. The math that used to work: buy a home, build equity, refinance when rates drop, retire with an asset, assumes conditions that don't currently exist for most first-time buyers. So people stretch. They take on a mortgage payment that eats 40% of their income instead of the recommended 28%. They tell themselves it's temporary, that a raise or a refinance will fix it later. Sometimes it does. Often it just becomes the largest fixed cost sitting on top of everything from stages 1 through 5, which never actually went away. They just got quieter while the mortgage got loud. Stage 7, the retirement account that isn't growing. By the time most people reach their 40s and 50s carrying this stack of debt, retirement savings should be compounding seriously. For a large share of the middle class, it isn't, because there was never a decade of surplus income to put into it. The 401k has something in it, but not enough, because every dollar that could have gone there for the last 20 years was already spoken for by a loan, a card, a bill, or payment plan. The average American nearing retirement age has savings that fall dramatically short of what they'll need to sustain their current lifestyle for even 10 years without a paycheck. This isn't a story about people who didn't try. It's a story about a system where every stage of adult financial life had a debt product sitting exactly where the savings should have gone. Stage 8, the trap closes quietly. Here's what makes this different from a single bad decision or one bad year. None of these stages on their own look like a crisis. Student loan is normal. A BNPL purchase is normal. Credit card balance is normal. Car loan is normal. A mortgage is normal. Each one individually is something a bank, a lender, or an advertisement told you was a responsible, ordinary financial tool. Stack all 8 stages on top of each other across 25 years, and what you get isn't a person who made bad choices. What you get is a person who did almost everything the system told them to do and ended up with a net worth lower, adjusted for inflation, than their parents had at the same age, while working just as hard or harder. The middle class isn't disappearing because people stop trying. It's disappearing because the products designed to serve them at every stage of their financial life were never actually designed around their long-term stability. They were designed around originating the next loan, and a system that profits at every single stage of your debt has no incentive to help you reach the stage where you don't need it anymore.